Hello, and welcome back to our Nonprofit Auditor Points. I'm Irina Ryshkova, your nonprofit auditor. Let's continue our conversation about Form 990 series. And we are moving forward to part 6, which focuses on governance. Part 6, if you look in the Form 990, you will see it's divided into sections. Section A covers governing body and management, and Section B covers policies. Because these sections answer different questions and they deserve proper attention, and we will be covering them in a separate episodes. So today we're gonna talk about Section A, which is governing body and management. In the next episode, we're going to talk about governance policies. Okay, let's do it. Part 4 is the most closely reviewed section on the Form 990, not only by the IRS. A lot of donors, funders, watchdogs, organizations, journalists, state regulators, and simply users of information look at that section first. Section A in particular answer very basic but very important question for everyone who is reading the return. Who is actually in charge of this organization? How independent the members who are in charge, and is there any oversight? This section not just collects names and numbers, but it creates a public picture of authority, influence, and accountability inside the organization. It's like a foundation for every nonprofit, very critical. One of the first challenges is to understanding Section A terminology. This terminology, it's not just based on a common sense. This is the terminology that IRS, the Internal Revenue Services, explain which each term means. Form 990 uses very specific terminology, referring to governing body members, officers, and key employees. And these terms should not be interchangeable. They're very unique and specific. So let's make sure that we understand what the IRS mean by the governing body, officers, and key employees. So governing bodies are members, meaning voting board members. And it's typically self-explanatory. Board members that can vote. Officers. Officers are not necessary board members. For example, an executive director is almost always officer of the organization, but may or may not be voting members of the board. The same true for chief financial officer and other seniorship roles. Being an officer reflects management authority, not board membership. That's important. So you can be officer, but not board member. And the next term is a key employees. It's a very defined category that always misunderstood. From the IRS standpoint and for 990 purposes, a key employee is generally somebody who has more than $150,000 in W-2 compensation. Once again, key employee, it's employee that's generally somebody who has more than $150,000 in reportable W-2 compensation. It's a very technical terminology, simply based on the compensation, and does not reflect the importance of how valuable employee to the organization. If it's more than $150,000, it's a key employee. Also, Section A asks whether the family or business relationship among board members, officers, and key employees exists. This question is not about wrongdoing, it's about transparency. There is nothing wrong if there is relationship, they just needs to be disclosed. For Form 990 purposes, the IRS defined family members very narrowly, and it includes only spouses and ancestors, such as parents, grandparents, children, grandchildren, great-grandchildren, and spouses of children, grandchildren, and great-grandchildren. That's it. In-laws and other than spouses are not considered family members for this purpose. Former spouses not considered family members. Aunts, uncles, nieces, nephews, cousins, they're not family members. These definitions are very important because the organization needs to be transparent. Again, there is no red flags. It's just very critical not over disclose and under disclose relationship. Another focus of the area section A is the concept of independent voting members in the governing body. This is one of the most misunderstood area in Form 990. Once again, it's independent voting members. Independence does not mean that the board member is not ethical or objective or supportive of the mission. Independence is the term that's specifically used for the IRS criteria and is evaluated for the year that under reporting. So 1 year a person might be independent, another year the person might lose independence. Let's see what should happen for the member to lose independence. One most common ways to lose an independence if it's through employment. If the board member receives W-2, meaning the board member was an employee of the organization and any time during the year, the board member cannot be independent that year. The dollar threshold, it does not matter. It could be $1, $1 million, does not matter. There is no dollar threshold. The fact of the employment alone removes the independence. Another common situation when the board member can lose independence, it's payment for the service. If the board member provides service to the organization as an independent contractor, not as an employee, and receives more than $10,000 in a year under reporting, the board member is no longer independent. Smaller cumulative payments below threshold do not automatically destroy independence, but one threshold exceeds $10,000, independence is lost. Again, $10,000 is not one-time payment. It can be spread out, but cumulatively, threshold is reached during the year. Another way losing independence is through business relationship. If the organization enters in the business transactions with the entity that is controlled by or significantly influenced by a board member, independence may be destroyed, even if the board member does not receive compensation directly from nonprofit. The key issue is economic benefit and control, not just direct payment. For example, nonprofit can pay rent to a landlord who is landlord is a board member of the organization. These rules create very common real-world scenarios. An executive director who also sits on a board cannot be independent. A teacher that serves on a board but also receives W-2 as an employee of the organization also is not independent. A board member who provides consulting services and paid more than $10,000 during the year, it's not independent. But in the same time, there are situations that do not destroy independence, even though they must be disclosed. Those of family relationship is a very good example. Board members might be related through family, but they are not automatically will lose independence. If the mother and daughter serve on the board, They both still be independent for the Form 990 purposes if neither of them is compensated. Neither provides services that paid by nonprofit, neither has a qualifying business transaction with the organization. The family relationship must be disclosed, but independence is not automatically lost. Section A also give readers indirect insight how governance function in practice. This does not come from the single question, but from overall perception of the answers. Experienced Form 990 readers look at the numbers of and independence versus independent members, disclosed relationship, management role to understand whether the oversight appear balanced, intentional, and transparent. Again, there is no right or wrong answer. Transparency is the key. Section A includes questions that may seem administrative, but send strong signals about internal control and accountability. One example is the question about the governing body documents its meeting. There is no federal or legal requirements tied to this question. There is no automatic right or wrong answer. However, Form 990 reader reporting board members generally suggests active oversight, engagement, and documentation. It's a good practice for the board members to have written minutes of the meetings. When the organization reports that the board met during the year and minutes are prepared and maintained, that indicates a function governance process rather than governance in a name only. It means that the board intentionally want to preserve the information that was discussed, their thought process and decision making. If we take together all answers provided in Section A, give us a pattern. Readers do usually judge nonprofit based on the accumulation of the responses, not one response. They evaluate the size of the board, its independence, relationship inside the board, management role, and meeting practices. It all should fit together. Even when answers technically correct, they should be misunderstood in terms how they read to donors, funders, regulators, and public. Make sure that your answers are truthful, transparent, and provide coherent pictures to the readers of Form 990. In the next episode, I will move into Section B, Part 6, which focuses on the governance policies and disclosure practices, including conflict of interests, whistleblower protections, document retention, and how Form 990 itself is reviewed. For now, the key takeaway from this snap. Section A, Part 6 tells the public who is in charge, how independent the board is, and how accountability is structured inside the organization. All those are very critical to understand fundamentals of nonprofits and if it's governed properly. Thank you so much. Thank you for being here with me. Be safe and see you for the next snap.